Listen, something historic just happened in the copper market, and if you don't understand what it signals, you could walk straight into a trap that's been building for months. While most people were distracted by economic headlines, while Western analysts were focused on inflation data, physical copper and manufacturing hubs across Asia reached unprecedented pricing levels. Right now, not theoretical, not projected, not some analyst's forecast, real transaction pricing, actual deals being executed, metal changing hands at prices that make zero sense compared to what the official exchanges are showing, and at the same time, the LME, the exchange that's supposed to set the global price of copper, is trading at levels that create a massive disconnect. That's not normal. That's not market noise. That's not a temporary dislocation that will smooth out when supply chains normalize, that ease a fundamental gap between what physical copper actually costs to secure and what paper contracts claim it is worth. And that gap is about to force a reckoning that most market participants are completely unprepared for. Before we dive in, I need to be clear. Nothing here is financial advice. I'm not telling you what to buy or sell. I'm presenting facts, mechanics, and historical patterns. You're responsible for your own decisions. Drop a comment. Do you understand what physical market leadership means? Because what happens in the coming weeks could be fast, violent, and irreversible. And your position, whether you're long, short, or sitting in cash, will determine whether you profit or get crushed. Here's the core situation, and I want you to focus on these numbers because they're not opinions. They're not models. They're verified data points from the physical market. Physical copper transactions in Asian manufacturing centers, pricing that reflects actual delivery costs, actual urgency, actual supply constraints, LME paper contracts showing prices that assume normal supply, normal delivery times, normal availability. That's a split market. Two prices for one metal. One price where actual physical transactions occur, another price where financial contracts trade. And when that happens in any critical commodity, when physical and paper diverge beyond normal bounds, the resolution is almost never smooth. It's forced. Now, I want to be precise here because skeptics will immediately say those are spot prices with delivery premiums. Physical always trades above exchange prices. You're comparing apples to oranges, and yes, physical pricing includes premiums. That premium isn't automatically manipulation or market failure. It reflects real costs, delivery costs, urgency costs, logistics costs, storage costs. All of those are legitimate components of physical pricing, but here's what matters. Even after accounting for those premiums, even after you strip out the normal markup that physical always carries, when the gap reaches certain thresholds, it's telling you something uncomfortable. The screen price is becoming less relevant than the delivery price. Think about what that means. For decades, the LME set the price. Miners used LME as a reference. Manufacturers used LME as a reference. Investors used LME as a reference. The paper price was the price. But when physical markets are transacting at levels that create substantial gaps above paper markets, the question becomes which one is real? Which one reflects actual supply and demand? Which one can you actually execute at if you need metal? And the answer is increasingly clear. The physical price is real. The paper price is lagging. And when the delivery price starts leading, paper pricing loses authority. It becomes a derivative, a secondary indicator, something that follows rather than leads. Now, once that psychological shift happens, once market participants stop trusting the paper price, the paper market loses its control. This is the trap. When this gap has to resolve, it cannot persist indefinitely. The market will force resolution, but resolution can happen into very different ways, and understanding both scenarios is critical. Scenario A, paper chases physical. The exchange price gaps up and starts catching physical reality. That triggers short covering. Traders who sold copper at lower levels are now underwater. Their brokers are calling for more margin. Some panic and cover. Their covering is forced buying, which pushes the price higher. That triggers stop-loss orders. Traders who had stops at certain levels get hit. Their stops become market orders to buy. More buying pressure, more upward momentum that triggers algorithmic trading. Huffed. Systems detect the breakout. They pile in more buying, and that creates a cascade. Price moves like an elevator, not stairs. It doesn't climb gradually. It jumps in a matter of hours, maybe minutes. This is what happens when paper finally capitulates to physical reality. The adjustment is violent because it's been delayed. The gap that should have closed gradually over weeks gets closed in hours. All the buying pressure that was suppressed by denial suddenly releases at once. Scenario B, paper tries to crush the narrative. Heavy sell programs hit the market. Large institutional sellers, possibly trading houses who are short, dump massive quantities of futures contracts. The screen goes red. Price drops sharply. The headlines scream that the physical premium was fake. Retail traders panic and sell. Stop losses get hit on the downside, and the narrative is, see, the physical premium was temporary. The real price is what the exchange says. Everyone calm down. This is psychological warfare. The goal isn't to reflect supply and demand. The goal is to convince everyone that the paper price is the real price and the physical price is an anomaly, to shake out late buyers, to restore confidence in the paper reference, to prove the exchange is still in control. But here's the problem with scenario B: it only works if physical demand cools off. if after the smash Asian buyers shrug and stop paying elevated premiums? If manufacturers lower their procurement prices, if the physical market accepts the paper market's verdict, but what if they don't? What if factories are still paying elevated prices after the exchange drops? Then the gap just got wider, and that wider gap proves the opposite of what the smash was trying to prove. It proves the physical market doesn't care what the exchange does. It proves physical demand is real, urgent, and inelastic. And once that's proven, the smash fails. Price recovers within hours or days. And when it recovers, it goes higher than before because the smash shook out weak hands, transferred metal from panicked sellers to strong hands, and proved the physical market is leading. So the market becomes a test of control. Does paper successfully intimidate physical, or does physical reality drag paper upward? Either way, volatility risk is high, especially for leveraged traders. Now let me explain why physical pricing in manufacturing centers matters, because a lot of people hear Asia physical markets and assume it's irrelevant. That's just regional pricing. That's not the real market. Wrong, completely wrong. Physical pricing in manufacturing centers is where physical tightness becomes visible first. Because manufacturing has one brutal rule. When metal is scarce, its price adjusts immediately. There's no smoothing, no managing, no public relations. If a supplier has limited inventory and 10 factories need it, the price goes up until only the most urgent buyers remain. That's supply and demand in its purest form. But paper markets can delay reality. They can manage perception. They can use derivatives to create synthetic supply. They can roll contracts forward to avoid delivery. They have tools to maintain the fiction that everything is fine. Manufacturing markets can't do any of that. Manufacturing is cash and delivery. You pay, you get metal. Or you don't. There's no complexity, no leverage, no rolling, just physical settlement. And when enough manufacturers are willing to pay elevated prices in the real world, it changes psychology. The industry starts realizing, wait, copper is not actually trading at exchange prices if we try to secure it. They see the screen price, they go to buy. And they're quoted much higher. That creates cognitive dissonance. Which price is real? Increasingly, people conclude the real price is what they have to pay, not what the screen shows. That's how narratives break. Now let's talk about why this matters structurally. Exchanges are futures exchanges. They allow traders to buy and sell contracts representing future delivery of copper. Traders can go long or short. A huge portion of this activity is financial settlement. Most contracts are rolled, closed, or cash settled. Only a tiny fraction result in actual physical delivery. The system works beautifully as long as two conditions hold. First, physical demand stays calm. Second, confidence stays intact. As long as everyone believes physical delivery is available if needed, the paper market maintains authority. But when either condition breaks, the system's weakness shows. Paper is leverage, physical is final settlement. Exchange open interest often represents massive tonnage, but registered inventory, the metal available for delivery, is a fraction of that. That is a leverage ratio that works fine as long as only a small percentage of contracts demand delivery. But what if the percentage demanding delivery increases? What if industrial buyers seeing the gap decide to buy exchange contracts and demand delivery to arbitrage the gap? Suddenly the exchange needs to deliver tonnage they don't have. What happens? Force majeure, cash settlement, rule changes, chaos. This is the structural weakness. The paper market is built on the assumption that physical demand stays low. But when physical tightness emerges, when buyers actually want metal rather than just price exposure, the assumption breaks and the system becomes fragile. Now let's address demand. Copper is not just an investment story. It's a supply chain story. And the demand drivers don't pause just because the price rises. Electrification. The entire global economy is electrifying. EVs replacing combustion engines, renewable energy infrastructure, grid upgrades, charging networks. Every time we plug something in, we need more copper. A regular car uses about 15 kilograms of copper. An EV needs around 80 kilograms. That's more than 5 times as much. If we start making 30 million EVs a year, that's massive copper demand. Then there's renewable energy. Solar farms, wind turbines, battery storage systems, all copper intensive. A single wind turbine can use up to 5 tons of copper. Then there's infrastructure. Governments worldwide are investing in infrastructure upgrades, new buildings, transportation systems, telecommunications networks. Every single project requires copper, and the data center boom is causing an explosion in facility construction. Every server, every cooling system requires copper. Here's the critical part. This industrial demand is inelastic. Industrial buyers aren't trying to speculate on the price. They need to secure their supply. If the price of copper jumps 20%, a manufacturer doesn't just stop production. They can't. They have contracts to fulfill, deadlines to meet, and customers waiting. So they pay the higher price. They absorb the cost and pass it on to their customers. The product might cost a bit more, but production keeps rolling and the demand for copper continues. This is completely different from investment demand. An investor might see elevated prices and think that's expensive, I'll wait. But a manufacturer can't wait. For them, availability is more important than price. This inelasticity is what can trigger explosive price moves in commodity markets. When demand doesn't react to price, either supply has to increase or the price has to go high enough to destroy demand. But for copper, demand destruction would require prices to go to extreme levels. The elevated physical pricing we're seeing in manufacturing centers is exactly that rationing mechanism at work. The market is saying, if you need copper right now, you pay the premium. Now let's get to the signals to watch. Signal 1, does the exchange price move up and stay above key levels? If the price opens higher and holds above significant technical levels, that's scenario A, the paper market is chasing the physical price. Shorts are covering and momentum is building. Signal 2, do physical premiums stay elevated? If elevated premiums persist, it confirms the demand is real and sustained. Signal 3, does the spread shrink because paper rises or because physical falls? If exchange prices jump while physical stays elevated, the paper price is chasing the physical price. That's scenario A confirmed. Signal 4, are there signs of inventory stress? Look for reports of delivery delays, refineries rationing supply. These are signs of physical tightness. Signal 5, watch the volatility. Huge price swings suggest battle. But if the price steadily grinds higher, it suggests buyers are overwhelming sellers. If you're positioned in this market, here's what you need to know. If you own physical exposure, don't panic if volatility brings temporary drops. The long-term fundamentals haven't changed. If you're trading with leverage, be extremely careful. You could get stopped out even if the long-term trend is favorable. Consider reducing your leverage. If you're holding a short position, you are in an extraordinarily dangerous spot right now. The risk-to-reward ratio is terrible. The smartest move is to cover and wait. On the other hand, if you're sitting in cash waiting for that perfect moment, you need to understand that waiting might mean you miss the entire move. Physical markets experiencing shortage don't give you comfortable entry points. They give you violent, explosive entries. You either get positioned ahead of the big move or you end up chasing it higher. So here's the bottom line. Seeing elevated physical pricing while exchange prices lag is not an anomaly. This isn't noise that's going to fade away. This is a stress signal. It is the physical market screaming. That supply is tight, demand is urgent, and the paper price is wrong. History shows us that when the physical market starts leading, the paper market eventually has to follow, and it doesn't follow politely. It's forced. It happens violently through price gaps, cascading orders, brutal squeezes, and chaos. The coming period is when the market will be forced to decide, will the paper market successfully defend its narrative? Or will physical reality force paper to acknowledge elevated pricing? One way or another, the market is going to answer a question it's been avoiding. That question is, which market is real? Which price truly reflects actual supply and demand? For decades, the exchanges were real. The exchanges had authority, but that hierarchy is cracking. The physical markets are asserting a different price. And if that price holds, then authority has shifted. Physical will lead. Paper will be forced to follow. Drop a comment below. Do you think the gap closes by moving up or gets pushed back down? Your answer reveals whether you grasp the magnitude of what's happening. This isn't just about short-term trades. This is about a structural shift in a globally critical commodity market. It's a shift away from paper control toward physical reality. And in shifts like these, fortunes are made and fortunes are lost. You need to make sure you are on the right side of this move.